I really do hope the seminar goes well. You will have seen there are 4 questions, one on technology, one on structures, one on trust, and one on future skills. Would you allow me to provide you with a further consideration? And that is, what's the reality? The reason I ask this question, if we go back to the 1980s, in markets and also in New York, there was the share rigging scandals, the Guinness affair, the Blue Arrow affair. We go into the 90s and we have Enron, then we have Marconi. Then we have a whole series of scandals, probably the last big one being Volkswagen. Research shows 2 things. The first, how management and somebody in the organization knew of the scandal, and yet nothing was done. And in fact, if we go to Marconi, more than 60 top managers knew what was happening in Marconi and could predict its bankruptcy 5.5 years into the future. To be precise, 65. Prediction turned out to be true. Second, after each of these scandals, what we had is a report, legislation, recommendations for further compliance. And we've done nothing different from the 1980s. Scandal, compliance, scandal, further compliance, scandal, further compliance. So my question to you is that sufficient? What is the reality of our future that we have to face up to in order to make the 4 questions that have been circulated meaningful? And I pose this question to our panel members, but I also pose the question to our seminar members as well. In your asking of questions, in your raising of points, could you please consider what is the reality of our future and what is it that we have to go through in order to make the future work? Thank you. I'll now hand over to Nada.
Good morning, everybody. Thank you very much for being here. What I will talk about is really the trends that we see happening in the governance and in the marketplace. The nature of governance, I'm sure you are all very familiar with. It is about compliance as well as stewardship. And at the moment, the pendulum is certainly towards compliance. It's a protocol, discipline, processes. And our research shows that 82% of all companies are really putting a lot of emphasis on compliance, and very few are really doing anything about stewardship, which is soft issues, really helping management and understanding what's going on in the organization, facilitating, coaching, and engaging with management. So the governance really to be effective, what we found out is to be dynamic. It has to combine compliance with the stewardship. And we found out that it's only 18% of our sample, which is very large, that the best practice is really that dynamic governance of compliance and stewardship. Also, what we see that certainly we have a lot of skills and in the marketplace about managing, from governance perspective, managing tangible assets, liquid assets, fixed assets, risk management, and we have a lot of financial skill and generalist skills on the board. What is also needed is managing intangible assets, and some companies, of course, are quite good with that, especially if you are in the pharmaceutical industry. They do have to deal with patents, copyrights, trademarks, franchise, etc. However, not every company have developed those skills in managing intangible assets. What we see now, the pendulum is really moving towards managing intangible assets, which we really need more and more, and less so of tangible assets. So more needs for example, technical skills, specialist skills, than just financial skills. So that pendulum is really going towards. Can you hear me? Is it okay?
Yes, Nada. Thank you.
Okay. So that's the pendulum where it's going. I'm just trying to change the. Okay. So what are those drivers really that we see which change in the future of governance? Certainly the biggest driver is structural capital. And I put here just about debt to equity ratio. We're talking about really developed markets, financial markets, financial instruments, and it's really very much what we see in Anglo-American economies as opposed to those economies which are less exposed to the markets. So that markets is really driving a lot of those things. Also, we see certainly government regulation and institutional arrangements which also drive those changes. In technology and technological innovations. Number one, we see artificial intelligence, and we see that now 2/3 of all cash equity trading and 50% of all foreign exchange spot trading automated. It's all artificial intelligence driven. We also see a lot of machine learning, which is a subset of artificial intelligence. It was really system which learn by themselves from the data. And who generated data? People generated data. So those machine learning systems learn our biases as well, okay? And they're going to be more difficult to detect because it's such a huge data system. So that is something new which we have to contend with. And of course, those technological innovations, they create new organizational forms. And those, so I'll just talk about new organizational forms as well institutional changes. Every time when we have fundamental challenge in society, we also generate particular decisions which then leading in particular way. Like, for example, after the Second World War, we generated a welfare state, and then we have in 70s economic crisis, neoliberalism. After the financial crisis, we put a lot of emphasis on ESG, environmental, social, and governance, and those initiatives are now really developing. After current pandemic crisis of COVID-19, what we're going to see, we're seeing more and more global oversight. International organizations are taking more central role, like WHO and National Health Association. So we're going to see more global oversight of more centralized governance, if you want. For a better or for worse, of course. What are going to be consequences of that? Well, we're going to see a lot of bailouts. And we know that governments are injecting a lot of cash to bail out many companies. We also see very large rise in national debt and negative interest rates. So in economics, everything we knew about economic models are not working anymore because we have negative interest rates, because all our knowledge was on positive interest rates. So now it's really a completely different set of premises and assumptions and different models. We have increased social unrest from a few years ago, Occupy New Street in London, to now George Floyd's protest, which is now really happening across the globe. We also have increased tax avoidance and tax minimization, rise in executive pay, and also rise in non-government organization, non-for-profit, or tech sector organization. We have new organizational form, and marketplace is moving towards self-service, away from human interaction, and that is through technology. Just to show you how much growth is in a non-government organization and why, and you'll see the countries which have particularly dependence on financial markets, US, UK, Israel, and like with Romania. And thank you, Kamel, for helping with data for Romania. You can see that those countries have extensive growth of non-tech sector or non-government sector organization, not-for-profit organization, which is telling us that it is a failing of the state. State cannot provide for certain goods and services for citizens. When you see the Germany, which have a less dependency on the market. We have only 43 companies, German companies on stock exchange in Frankfurt Stock Exchange. Germany has only 620 NGOs. So can you see how the structure of the market, of financial market, drives certain behavior of the firm and society? So what we also see in the organizational forms, we see a lot of platform organization, those which are facilitated by technology, which are really algorithms, really, which like Amazon, eBay, Facebook, Uber, Alibaba, those are really growing companies. We also have virtual organization, which is software relationship network, teams, smaller organization of network of a smaller horizontally linked, which are really horizontally linked or integrated organization. Rather than vertical integration, we have horizontal integration. And they are growing. We also have growth of social enterprises, which are something in between of NGOs and commercial sector. They are businesses with purpose, and they're also for social purpose. So they do make profit, but they're for social purpose. In US, they call them B Corps. In UK, they call them social enterprises, and in other places, they call them for-purpose enterprises. So they make profit, but for social purpose. We have also community-based organizations, non-profits, which are also associations in various forms because there are needs for them. And we have a rise of venture organizations. Of course, they've been with us forever. However, those privately held organizations much more focused on technology. They are really technological drivers, which is really for growth. So very much technology-based organizations, which we see. And what does it mean for governance? What are new trends in governance? All this we see a lot of regulatory change. For example, compensation disclosure, say on pay, appointment of majority voting, by majority voting, employee representation on the board. Those are all new initiatives. In the background. We have also greater compliance.
I have muted everybody, but some people are coming from mobile connection.
It's a terrible noise.
Please keep your hands, the ones from I cannot do that. You please mute yourself. I'm sorry. Please. Anita, yourselves. Nada, can you hear me?
Yes, I can.
Perfect. Now, could you please share again the screen?
Okay. How do I do this? Just a moment. I have
the third one. Share content.
Yes. I'm sharing the screen again. Yes. Okay. Just a little bit twice. Okay.
Yeah.
Sorry for that. And so what we're seeing really new trends in corporate governance, and major one is regulatory changes, which is really, for example, compensation disclosure, say on pay by vote, appointment of NEDs by voting, and other executives on board employees representation. That is a new initiative. We have greater compliance to data and artificial intelligence, and that is really a problem. We need dynamic, remember I said we need dynamic governance, which is really oversight as well as stewardship, as well as compliance. But with the new technology, it drives even further to compliance, and that is going to cause really a problem. We see also more flexibility on board leadership structure, who can be a leader, and we have independent directors. We have also diversity of thinking, which is important, but not diversity of values, which is means that people should have the same value surrounding on the board rather than the difference of values. But yes, they can have the diversity of thinking, which is also a bit of contradiction. We have more dynamic flow of information across organization, across the board, border management, and other organizations. So that flow of information is much faster and dynamic. What is required now for board more and more to balance the social and economic logic. And why? Because for all these reasons which I mentioned before, that government is less and less able to provide for citizenship, and we have those third sorts of sector which is also not able to satisfy the gap between needs. So more and more is initiatives that boards and organizations will have to balance their social and environmental logic. So that's ESG focus. Focus is also more on technology, and especially between interaction between human and artificial intelligence system, as well as artificial intelligence system and human interaction. So there are two critical interaction: human IE and IE human. So data security, big data, artificial intelligence, learning, automated learning, highly regulated sector like telecom and banking and insurance are already in that space. Many banks now, they say that they are really IT companies with banking licenses. So that is a really, really big shift, and pendulum is swinging really strongly for the technology. So technology will be affected by governance, and governance will determine which technology should be developed and for whose benefit, and how that is going to be implemented. Those are really trends in the corporate governance space. Thank you. Any questions?
Thank you, Nada. I think for question session, the person who would like to start, please unmute yourself. But before that, I suggest that we give the floor to Ona for her input. And Ona, could you please start? Let me know whether you need help, technical help. Ona?
Hello, everyone. Good morning. It's great to be here and have this chance to speak. I'm just getting my...
I can hear you, so it's okay.
Can you hear me?
Yes. So
Great.
please go on.
Lovely, thank you. In preparing for today, I have been reflecting, in many ways, like Nadia, over my last 30 years in the boardroom. And one of the things we decided as a group was to give you some examples of the kinds of decisions that get made in the boardroom. And I've been reflecting on where boards have come from, like NADA, and where boards are now, and particularly Andrew's challenge of what is the new reality and what does this mean for the board. 30 years ago, I was a young chief executive having to go to my board to say, at the start in the 90s recession, to tell the board that actually we had to protect our cost base because we couldn't deliver the level of profits that they were expecting. And of course, that meant cutting staff. Fast forward to the next global financial crisis. Again, I was in the boardroom, and again, we had the challenge of how to protect investor returns, but what to do about the cost base, which again was largely people. And here we are again, 3 times. And what's changed over those 3 times from the 1990s to the global financial crisis today? And NADA's done a great job of laying out the roller coaster of regulation and scandal. And Andrew and has shown how that compliance culture has developed. What struck me about the early 90s, we were post-Thatcher almost, but the culture was very paternalistic. And although some people did the redundancy programs very compassionately, some of them I think were rather guilty, feeling guilty, and many people would just get a telephone call telling them not to come back to work. It was a very harsh period, and not surprising that we got a lot more regulation. But by the global financial crisis, that paternalism had gone, and in boardrooms there was much more focus on investor returns. And as Andrew and Nada have pointed out, we've seen a much greater change in the last 10 years as we have focused on culture and values and purpose, as really focusing on, as boards, actually it's the behavior in our organization that can destroy our reputation overnight, can destroy our corporate value. And so we've seen many more board agendas having those issues on their agenda: greater transparency, speak up cultures, etc. And as Nada said, by this last year, we've seen considerably more focus on ESG, and it's been very interesting to see the speed at which the city of London financial institutions have really accelerated this drive for boards to be much more focused on the climate change issue. So, and just to illustrate that, I'm a member of Chapter Zero, which is the Directors Climate Change Forum. And we've got 700 members in less than 12 months. And it was set up by the World Economic Forum to focus on climate governance last year at Davos. So we are seeing, what I see when I look back is how in the boardroom, the complexity of decision-making has just been accelerating and accelerating, not just about creating value for investors, not just the culture and the issues and the environmental issues, but now with COVID, we have seen a much bigger recognition. COVID has shone a light on the level of inequalities that we have in our society. And that has been reflected in many of the webinars and conversations I've had with my fellow directors. A much greater understanding and appreciation of the moral hazards of taking government money and the social consequences of the decisions we make today. In fact, my very last pre-lockdown dinner with a group of board leaders, and rather prophetically, we ended on the note that this lockdown and the ensuing economic crisis could be a real opportunity for business to rebuild trust if we could get it right in terms of the social consequences. So looking back over that time, I see the boardroom having to make many more complicated decisions. And what has happened, and I want to focus my comments really around this issue that that Andrew raised, about what are the future skills of the board, what are we going to need? You know, what has happened, as Nada has said, is certainly over the last decade, we've seen headhunters begin to extend their talent pools beyond the traditional chief executives and finance directors to bring in HR directors to help with these culture and values issues. And there's even been a few people who've managed to get cyber experts on their board, and there've been the odd person who's got an expertise in environmental issues, depending on the actual sector that the board is in. But we haven't seen a lot of development in the board around some of the issues that Nada was indicating. We are seeing a new generation of non-execs emerging who go outside the boardroom and go out and listen to employees and even customers and suppliers. But again, they're not in the majority. And we've seen a rise in stakeholder advisory boards like the one I was on at Walgreen Boots, as another way of listening to stakeholders. But I think this issue we have today about this human AI systems interface is really critical because of the social issues that it raises, and the need for the board to have now that greater understanding. And that creates its own challenges. We've seen, and as a result of the pandemic, this has accelerated. So COVID has shown companies just how technology can help. And what we're seeing is that many companies are accelerating their investment decisions and implementing tech investments, whether it's data analytics, blockchain, AI, or cyber, because of course we've seen masses of cyber attacks as well. And so many companies are now implementing tech very quickly. I've heard of projects that would in the past have taken a year being done in a couple of months, as we've seen with the government trying to do track and trace. And boards are also revisiting their whole business model and asking, what will the future look like? And what are the changes we're going to make in our business model over the next decade that actually we need to make now? So this is an opportunity to change and use the technology to help us pivot our business model. But as I said, with this comes many more social risks. And as we've seen with the challenges of track and trace apps, public trust in our technology, in protection of our data, data security, just to name one, is not there. And if we don't have that public trust, which we have been just losing since that very first recession in the 90s, or at least the first in my career, we really are going to have trouble, not just keeping our businesses alive in this new world, but also protecting the lives of our people. So I think we are, I think, in the boardroom seeing actually quite not only more complexity, but what appears to be a much more, I would almost call it a chaotic world. We're also seeing young people and looking at new organizational forms that Nada laid out. These new organizational forms characterize much more by delegated, distributed decision-making, where you've got lots of, particularly in the likes of say, for example, Spotify, where you have small teams doing software development with enormous autonomy to make their own decisions. And so as a board, your challenge is no longer, to make the right decision in the boardroom. It is, how do we distribute that decision-making? Governance, for me, is very much about decision-making by those who really are on the front line making decisions about customers and suppliers, and in relation to investors. So we need a new set of boardroom skills, definitely. I think it's too early to say what the new reality will look like. I think most boards are looking at this now and saying it's going to be 6 months before we even know what kind of future we're really going to be facing. But we know it's going to be different. We know we're going to need new technology. So what do we need? And new skills and capabilities, I think there are three things. We need, I think, more boards with board members who have experience of leading these kind of flat organizations with highly distributed decision making and autonomy of teams, and anchored in very clear purpose and values, which is, you know, the only thing you can really hold on to in a business now is what is our purpose, where are we going and why, and how do we do what we do, so you can protect your brand and reputation. And I'd suggest you look at partnerships, professional partnerships. I've been working in that world for 30 years. And when you're leading a business of 600 partners and they're all making their own decisions everywhere in the world, you learn a lot about how to get that level of enterprise value for everyone. But I also think, and this is one of the things that became very clear during the last decade, boards were living in their own social bubble and were not well connected with the other parts of society. We need more people in the boardroom have a knowledge and understanding of the very different social issues and inequalities that are caused by the way the business operates, right through their supply chains as well, right through the customer side, the client side, and how the products and services are used. And also with the investor community. We need boards that have a much broader understanding of that whole ecosystem. And I think increasingly, yes, we've got this ESG drive, but I think we will see very soon that boards will be expected to produce their own statement of how they see the public interest in the whole business. I think from all Nada said and from all you can see, I think that will become more and more required, and they will need to then demonstrate how they're meeting their public interests, the social issues, as we've talked about, the environmental issues of every aspect of the business and through its supply chain and customers. And that public interest statement will need to have quantifiable evidence of how they're meeting their responsibilities. And that will include the AI interfaces as much as anything else. And auditors will have to audit that because their investors will need assurance. So that knowledge and understanding, I think, of public interest is going to be really critical. And then that brings me to the last area. So the experience of flat organizations, and knowledge and understanding of public interest in ESG, and then key competencies. People, we need three things. People in the boardroom who are real systems thinkers, who see the whole system and its interrelationships and where the fracture points are, because you can't do everything, you have to see the system. Governing culture, because culture does eat strategy for breakfast, and culture is what drives behavior, and at the heart of behavior is decision making. And what I'd like to call chaotic leadership as my third competency, by which I mean that ability of the leader now in the boardroom to hold the space between the chaos, the emerging chaos that we're seeing, and the need for control. And we can't do either of those anymore. And we need to hold that space, giving as much clarity of leadership as we can in a world that's chaotic. And what that means for our corporate strategies is that we cannot command our strategy from the top, which we couldn't do anyway 40 years ago. I'm a corporate strategist by background. We need to have strategies that can adapt to a world that is changing very fast. And that means we have to put more decision making in the hands of our people and enable them to make good decisions. That adds to their stress. And so we need to really support them in doing that. But we also need board members who systems thinkers, govern culture, can do this chaotic leadership, and can get out in, and that means they have the ability to be able to get out beyond the boardroom and bring back into the boardroom the voice of all those different stakeholders. And obviously we're seeing some of that developing, as I said, but I think we've got to do a lot more of that. So it's quite a long agenda for the board, Andrew, in terms of what I think is needed in the emerging new reality. But the path forward will be for people with that experience, knowledge and understanding and those key competencies.
Thank you very much. Thank you very much, Ona. I have to confess that I was writing in the same time you were saying things. I love the 3 competencies you have outlined. I think we have a long way ahead of us, and without wanting to hard sell the program, that's exactly what we have to do and we will do when professionalizing this role, which is actually of a paramount importance, but not so much, unfortunately, yet, I wouldn't say publicized, but advertised as such. Strategy is important, culture is important, values are very important, because we often forget what already Drew Kerr said, in the 90s. The companies who are going to survive and thrive in the future are the ones who are turning back to the values of the communities and giving back to the community. So public interest, exactly what you were saying. It's somehow funny, after so many decades, this is finally coming back to its rightful place. So thank you very much, Ona. So Giles, you have to take the floor now. How is it after 2 wonderful, big, powerful ladies?
Well, I'm most impressed by what's been said already. I'm going to be a slightly dissenting voice to what has been said, to create a bit more debate, perhaps. But I do want to address Andrew's question that he posed at the beginning. And I would say 2 things. One is that, well, my 3 themes are, first of all, the current paradoxes and dilemmas that boards actually have today and have had in the past. And Una mentioned what's happened over the last 20 or 30 years, and I agree with most of that. But when I've been on boards for 28 years now in one shape, form or another, and when things go wrong, it's because the basics have not been done correctly. And so I'm not a process freak, but basic processes have been ignored, and that's when a lot of things go wrong, and I'll come back to that. My second theme is more on the role of technology and how that is impacting board work and the nature of directors. And my third comments will be around, obviously, the future challenges and what a new board will have to have in terms of skill sets and its work and its agenda. So just going back to the dilemmas and paradoxes, it's the basic director's dilemma, which is still there, which is how do we grow our company successfully with all the modern requirements, but how do we control it at the same time? That is the core of all management problems when it comes to board work. And the answer to that has been, as Andrew pointed out, and Nada, different responses over time. Independent directors versus executive directors to try and create control. More information, more data. And the problem I find is that, in my experience, a lot of boards, people have placed their trust largely in the financial numbers. And the obsession has always been to get the financial numbers right. So the audit process, the capital structure, which Nada mentioned, of the company, these are all very important prerequisites for a company to succeed. But I've been on boards of companies where people don't know how much cash the company has. And yet cash is absolutely vital. If you don't have cash, you can't pay your people, you can't pay your suppliers. And cash management is a process that is still ignored, or at least not prominent enough. And you have extraordinary biases where an audit committee on a board is nearly always chaired by an accountant by training. And in fact, people insist that the audit committee chairman is an accountant by training. Well, actually, I've chaired an audit committee of a listed company, and I'm not an accountant. And the reason is it becomes an introverted process. The chair of the audit committee spends most of his or her time debating with the auditors on fine points of tax. But they don't ask the basic questions. How much cash do we have? What is our cash generation ability? And that's when the company hits trouble. And so the specialization at one level, I think, has been a problem. And yet the paradox is increasingly, when you're having a board that's working on these, the agenda that Una mentioned and Nada as well, you need a lot of specialization. You need a lot of skill sets which don't normally exist on a generalist type of director. So, for example, to actually create a board that's effective in a highly technical area, whether it's pharmaceuticals, Apple, whatever, understanding the nature of the work of the company, and yet you want diversity. And so domain knowledge of the business is absolutely vital. You as a director, whoever you are, cannot ask questions unless you understand how the business really works. And so the idea of the sort of amateur generalist director, I think, is gone. You've got to have a core understanding, and that involves the things that Una has said, which is you've got to walk the plant. You've got to get out of the boardroom to find out what's going on and what people think. But the problem I have with that is that you're asking, in many cases, independent directors to almost work full time for the company, because they've got to get out, they've got to talk to suppliers, customers, employees, and yet they're only supposed to be there maybe 1 day a week over a year. So how do you do that? So the demands on the director are huge. And as you said, they're going up. Now, the question then is, okay, how do you control the company? And what is the nature of oversight? I can give examples. I was on the board of the London Stock Exchange in the early 90s. And the board took the same decision 8 times in 4 years to build an electronic trading system, and failed each time to implement that decision, right? Because it was so controversial, right? So what was interesting about that is you could say that was very poor governance, because the board had taken the decision, but nothing had been executed. And I see that time and time again where poor governance process actually is not enforced. I'll give you a very simple example, but all of you who've been on boards will be familiar with this. Chief Executive proposes to the board that you paint the boardroom completely black, ceiling, walls, floor, because he thinks that'll make it look modern and edgy, or she thinks it'll make it look an interesting room. And the board don't really care one way or the other whether the room is black, brown, or yellow. So they say, okay, if you want to paint the boardroom black, paint it black. So the chief executive gets the black paint, and the directors paint the boardroom, and it looks horrible. It looks ghastly, and it's just vile, this black room. So the chief executive turns to the finance director and says, this is awful, get the white paint and put it back and paint it white. That is poor process, because the board approved the room to be painted black. So what you need to do is to reconvene the board, show them the black room, and agree to paint it white. And time again, companies have made decisions which the chief executive has either abandoned or he or she has changed without telling the board. And that again is where a lot of governance problems occur, strategic cock-ups, all sorts of things that happen, because actually the board decision has not been revised. I would also tell you that I think boards hate doing strategy. And again, the dominance of financial figures, and I'm afraid accountants, I'm not anti-accountants, but there are, in my view, too many on boards. Is what happens is the strategy process becomes a financial one. So the strategy becomes last year plus 5%, or last year less 5%. It didn't actually address what's actually wrong with the business model. And I mean, we have a supreme example, and Andrew asked the question. Look at Wirecard in Germany, the current scandal. $1.9 billion or euros had disappeared, right? By anyone's standards, that's an awful lot of money. And it doesn't exist, apparently. And again, there are examples of people knowing what was going wrong. And the most fascinating thing was that it proves the regulators are always the last to find out there's a problem. Because actually, people knew there were problems in Wirecard for 18 months. BaFin, the German regulator, actually banned the shorting of shares in Wirecard because the market knew there was a problem. So again, I would say that a lot of the processes that surround governance are not being enforced correctly. And so some of the changes do require culture, certainly require values, but actually just good process is missing in so many examples. I'll quickly move on to technology itself. I think there's a confusion between artificial intelligence and just automation. I think a lot of companies use a huge amount of automation. Nada mentions the fact that an awful lot of currencies and securities are traded on an automated basis. That's true. That's mostly algorithms. It's algorithmic trading. And that is something which is by and large an efficiency gain, because you had people shoveling bits of paper and telephone calls in the past, and now that's all automated. But here's the irony of technology, having made our lives easier. If you look at, for example, financial services, one of the biggest problems is you cannot get personal service in financial services now. If you ring a bank, you will not get through to an individual at a bank. You will be put through to a chatbot or an automated system. If you ring your insurance company to make a claim, it's very unlikely you can speak directly to a loss adjuster or anyone else. And so, having run a couple of securities businesses in my career, I found there were clients who were prepared to pay for personal service. They wanted to talk to someone about their numbers. So the digital divide has a paradox in my mind, which is if you're rich, you can buy personal service. If you're not rich, you can't get personal service. So here's the paradox of technology. Digital is improving our lives, but actually, if you're rich, you can only get the improvement and the personal service and pay for it. So again, I see some paradoxes in these technical advances, which are not necessarily good for all. One other thing I'd say on a board is that, going back to my earlier point about audit, I don't think the future director of any board can be on that board if he or she does not understand the technical infrastructure of that company. And if they don't understand it, they shouldn't be on the board. And you may say, well, you know, the head of IT will answer that question. Not good enough. Can you imagine if you were on the director of a board and someone said to you, what's your basic profit and loss and revenue last year? And you said to them, I'm on the board, but no, I talk to the finance director. She'll explain it to you, right? That would be completely unacceptable. That happens now with technology. When someone says to a director, what's your technical infrastructure? Many of them will say, I have no clue, but have a chat to the head of IT. She'll explain it to you, right? Can't go on that way, right? Why? Because there's so much risk sitting in the technical infrastructure. Huge amounts of risk, right? And Una's referred to that. So I would argue very strongly that domain knowledge of the industry is vital if you're being an effective director. And I'm afraid technical knowledge and the digital divide divides people there too. But I don't think you can be an effective director because, as Nada rightly pointed out, and this is my last point, in the future challenges, the shift is going on, as she rightly pointed out, between managing tangible assets and managing intangible assets. And the future company is very much one of intangible assets. So many companies now are simply consist in value of brand, intellectual property and software, and the quality of the people that work for the business. And it's managing those things. Brand is reputation, it's marketing and so on. So anyone who doesn't understand brand management is going to struggle in a lot of modern businesses. And I would add also that in terms of the model of a business, those models are changing, and the forcing of the models, as Nada points out, is partly economic, but I think it's also coming from the employees. And Una mentioned this. You know, I think it was Google where the employees refused to work on a Ministry of Defense contract or US Defense Department contract because they didn't agree with the company's technology being used for defense purposes. So I think a lot of employee work will be making huge values will have an impact on management too. So Una's right, you know, the directors need to get out of the boardroom and find out what the employees think. And I also think, finally, for an effective director in the future, besides all these issues of brand, is how do you debate corporate culture and the business model? Because if you were on the board of Wirecard's problems come from its business model. It was using third-party acquirers to bring them payment business, and they were accounting for those acquirers the wrong way. And that's why $1.9 billion went AWOL. I think the challenge will be how do I get the corporate culture to change, but how do I change the business model? If I'm just one of 10 directors on a board, do I work a majority, get people to understand that? But I can see that some of these changes, the ESG agenda, and I'll finish now, as Una pointed out, this has become a very big thing, but you're asking not very well structured businesses to handle society's problems. The code of conduct for asset managers in the UK includes the companies having to work for the benefit of society and the environment. Well, someone who makes, car tires isn't necessarily there entirely for the benefit of society as a whole. It's certainly for the benefit of vehicle drivers and the safety of people on the road. But I worry about the breadth of this agenda. It's too broad. And I think directors will give up and just say, well, we'll do our best. But we can't solve all of society's problems as a commercial enterprise. They will have to take that into account. They can't ignore it. But I think I can see, in answer to Andrew's question, a lot more convulsion before we have a solution to some of these problems. Convulsions is the future in the next 3 or 4 years. That's it.
Thank you, Giles. You managed to keep up on our toes, keep us on our toes. A very exciting point of view. I will ask you the question which already came up from the audience, and it goes directly to your point regarding using the artificial intelligence. You have it on the 2018 Larry Fink of BlackRock, $7 trillion under management has replaced 25% of its portfolio analysis with artificial intelligence to pick up stocks. So how do we communicate with them, and how will an investor day look like in the future of, using the artificial intelligence for us?
I think the BlackRock number is hardly surprising because automating processes like investment management, they believe they're trying to remove biases. But of course, as you know, with all systems, the inputting of the system is the key. If you put rubbish in, you get rubbish out. And
garbage in, garbage out.
Yeah. So, the nature of what's being used by some of these asset managers changes. As far as the artificial intelligence is concerned, it depends what you're trying to do. There are investment strategies which are looking for high income, they're looking for capital, as Nada mentioned, so on. And that's all fine. I don't see that changing because someone will have to explain to the investors why they made the decisions they did, right? In other words, the nature of the machinery they're using. If you use machine learning in investment management, you have a classic problem where, like indexation, for example, a lot of investment companies like Vanguard will offer you very low cost to track an index in a market. The problem is if everyone tracked the index wouldn't go anywhere. So if you had 100% tracking, nothing would happen, right? You need diversity of opinion in markets to make prices move. So you've got a problem, I think, which is if you index all your funds, you effectively eat the market you're trying to track. And so the investor day, I think, will be one where I see a big, what they call a barbell, which is half the market's going to automation and tracking, and the other half of the market's going to active management, where people still make bets on a human basis rather than on a purely automated one, and places in between. But I think the investor day will be much like they are now, just the nature of some of the investments available and the nature of some of the securities they invest. And Larry Fink himself, who runs BlackRock, is pushing with their investee companies, the need to be more ESG orientated. That's fine. It's good that he's engaged in the debate, frankly, because I think a lot of fund managers have been too quiet. I don't know whether that helps.
Yeah, thank you. Do you, Nada or Ona, would you like to?
I think that we're going to see more and more of that behavior, automatic trading, and we are going to see also as well an example of automated contract. Many contracts are now negotiated by two machines, which is automation. taking place even in a contract negotiation. So we're going to see more and more of decisions being automated. Okay?
Yeah.
And whatever you want to call it, machine trading or artificial trading, artificial intelligence trading, but certainly it's going to be, you know, where we're going. The question is going to be, where we're going to be human in that loop, when the human can intervene in the machine decision making. So some decisions are completely automated, and somewhere you have a person or in the human which can intervene in that loop.
We have been asked several times over the past month what's happening, you know, with the fact that humans are going to be replaced with artificial intelligence. And now we are not talking about the blue collars, the blue collar workers, but mainly if we are in the board. By the way, already the artificial intelligence CEO exists, so we know that, and it's quite performant. How about the board member? Is board member role going to be replaced, yes or no? And if is this really possible, or the main let's say the main quality of the human being is actually the one, you know, being creative and making decisions in a creative way? This is actually the thing that is going to keep the board member as a human being and not as an artificial intelligence item. So what do you think about that?
Well, in theory, yes, you could say yes, you can. Theoretically, yes. Practically, no. And I think there were experiments in Hong Kong where they had artificially intelligent as a board member, and that system was an additional board member because it could remember, you know, all past decisions within seconds. And however, there are issues of ethics as well as a legality. If you have artificial intelligence a system to make those decisions, so at the moment it's contentious. So that system is outside; it's not anymore used because there were legal issues about it as well as ethical issues about it. So it is our human decision where we get to put the gate, how far we're going to automate things and how far we want. And as I said, which technology is going to be developed further and which technology is not going. It is our human decision. So it's open to our minds how far we're going to go.
Yeah, if I come back to us in answering that question, I was thinking, well, what is the board's role? You know, primarily, you set the tone from the top, you set the direction for the business. Then your job is to make sure that the executive are actually delivering on what the direction is. And finally, providing assurance to all stakeholders that you're actually doing what you say you do. So I would love to have more machine learning and maybe some AI to help me as a director know what's actually going on in the business. And I'm sure the management information that we get is often incredibly poor. Every board I join, first thing I end up doing is, you know, demanding better management information. Well, it would be great to have some kind of way of interrogating the management information and getting at things like, as Giles said so well, you know, how do we get to know the tech infrastructure? Yeah, the tech guy can give you an overview, but actually you need some insight into it. So I think there could be a lot of aids for us, but I don't think it'll replace our job. It'll just make it easier for us to do a better job, I would hope.
Carmen, I went to a talk by a very senior member of a company called DeepMind.
Oh, yeah.
Yes.
Bought by Google. And this is a huge artificial intelligence enterprise. And the speaker made the point that actually, yes, you've got this fantastic machine learning, you've got these fantastic big data processes and so on. But there's a big difference between that, which is making huge strides, and as Una points out, could be very helpful to the modern director in understanding what's going on in the business, and actually replicating a human being in all its faults and unpleasantness and emotions and everything else. And his view was that it would be 3 to 4 decades before you get anything remotely close to something that behave like a human being. That's not a statement of complacency, I hasten to add, more one that we shouldn't be frightened of the process. That was his argument, but then he would say that, wouldn't he? Because he's running an artificial intelligence business. But nevertheless, I think it was an interesting counter view to the idea that robots are going to run our lives and we'll have no control. I do think that, as Una said, there's a lot of good things that could come from this. And we shouldn't be frightened. And I think, again, better understanding means better decision making. So the more we are curious about artificial intelligence, the more we will be in a position to do something about it. If we just fear it, then obviously nothing will happen and we'll just feel we've lost control.
Yeah.
Carmen, if I may, I will also have a question. I hope you hear me.
Yes, we can hear you.
So actually, I would like to question upon Carmen, and I have for speakers to. So I have spoken about the new leadership challenges. We need to combine the need of control and also Jill also mentioned that the board member should clearly know the technical infrastructure of their company. Which is, in your view, the most important human feature of a board member, which will, let's say, be needed to be emphasized these days when the new technologies will be, let's say, more and more complex? And if you see one, let's say, more important than the others, again, human feature, in which specific chapter of what we call strategy assessment, which is what boards needs to do, you will place it, or you will see it more important, more functional?
It's a really interesting question, isn't it? And I think Giles used the word. I would say it's that curiosity that leads one to want to learn and understand. Because as a board member, there is so much one has to learn and understand. And, you know, even preparing for today took me a week of lots of reading to get up to speed with what, you know, where we are and what needs to be done. There's fantastic work already done on this. So it would be curiosity and all that then leads to. And where I would put that of course, because I'm a strategist, is in strategy. Because, and I'd just say one thing about strategy. I don't think boards have been doing strategy for about the last 30 years. I think they've been doing financial forecasting, and even that's been pretty crude. And I totally agree with Giles on that. But strategy is back in the boardroom. Yippee! In other words, looking at beyond the immediate 3-year plan, where is the world going to go? We have no idea, but how are we going to navigate it, and what is going to be the core, what is going to be our emergent strategy, which is why I think purpose and values are so critical. And why curiosity is so critical is because we need everyone in the business being curious about the customer, the supply chain, the people in their teams, to learn and think, how do I need to adapt in my part of this business in order to continue to contribute to us achieving our purpose and strategy as that is envisioned, so that we can create the value for the enterprise and for all stakeholders. So
thank you.
I think that curiosity is critical to strategy.
Thank you. That's very interesting.
Adriana, I would answer your question by saying good judgment. Good judgment of people, good judgment of issues, and the ability to come to a conclusion about something, even if its information is not entirely comprehensive. But without judgment, you don't really have an effective director of any particular sort.
I think Yeah, I think those two together work very well because actually that leads to what you just said, Giles. If a board member is being asked for a particular domain, a particular information about the company, then they should be able to answer and not to send to the, let's say, IT guy or CFO person.
I also did in the meantime, before we get people with all those skills, there may be also room for what they call advisory boards or shadow boards, which are going to assist current crop of directors to make better decisions. And some companies are already having that with many kind of advisory boards, which advise them for particularly kind of areas which they don't have enough skills and capabilities. And that is, I think, intermediate solution.
Mm-hmm.
Thank you, Nada. You have one additional question from a person in the audience, from Simona. You mentioned among the trends, flexible board leadership structure. Could you detail a bit more?
Okay. At the moment, especially for example in UK, we have the board roles are divided between chairperson and CEO, but in USA we have mixture of chairperson, president, and CEO. It's all in one person. So that is a kind of flexible, and some companies having split role. And also there is a reason that why we have lead independent director, which are kind of ability to step in if the person who is a chairperson and CEO is replaced. So there is a more flexibility what kind of structure you're going to have. So it's a leadership structure. It's more flexible than at the moment. It's in UK is fixed. You have to have it split. In exceptional cases, even in UK, you have it in one person, but it's rather an exception rather than the rule.
Yes, thank you. One more question actually for both of you, because I know you work close to identifying individuals and profiling the boards. There was a question from the audience regarding the recruiting firms that are introducing the artificial intelligence to eliminate the human bias when scrutinizing people's CVs and so on. How do you see this as consequences influencing the recruitment of non-executive directors and so on, independent non-executive directors, senior directors, etc.?
I see that it's going to have a skew way because it is algorithmic at the moment. It's algorithm which pre-select certain skills and looking for certain words. So how you write your CV, it's going to pick up certain words. So I see it's going to introduce a new bias, which is going to take a longer time to address. Andrew?
If you go back to the dot-com crisis almost 20 years ago, the FBI were trying to create a profile of the director that is ethical. In other words, not corrupt. Now, what did they find? They found that about 80% of American businesses, British businesses, German, French, Scandinavian businesses, in governance regimes with which they're unfamiliar, for example, East of Yemen, whole of Africa, Central America, and South into South America, bribery was standard. So most companies were bribing monthly, quite regularly. It was almost marketing costs. Now, who was doing that? Honest people. And so the FBI dropped that very quickly because they found that it wasn't bias or bribery or unethical behavior that was the issue, it was context. And as we're going more and more into intangibles, the context of your company now becomes absolutely critical. And the question is, how can an algorithm accurately capture the context in which you will join just by looking at word ordering or for use of particular words? It has to be intimacy. It has to be, I get to know you, do you fit, do you not fit, and why? So the more we're into intangibles, the more artificial intelligence is going to be stored. The more we're into tangibles, rational thinking, We see it on a car production line. We don't need as many people. But there is a rationalist, sequentialist approach to the use of an artificial intelligence type mechanism. That's not where profitability is going to be in the future, or sustainability. It's going to be in the intangible area. So the danger is what the FBI found, hundreds of thousands of dollars spent, and then they had to hide it very quickly. And I think that's going to happen here.
Yeah.
Just add on that, Carmen, that one important, I've done a bit of research on this, but actually, if you're running a board as a chairman or a chairwoman or a chairperson, you need to choose the board you want, you think will be effective. And that's one of the responsibilities of a chairperson, is to make sure the board is constituted the way they want it, in line with governance requirements and compliance and all those other things. But that choice ultimately sits with the chairwoman, chairman. And therefore, even if the candidates are selected automatically by a headhunter, there's no obligation on the chairman to take those people that are being suggested. So I think that's, as Andrew says, very much a personal and human decision. It would never be one that's done entirely by machine.
And Giles makes a very good point. It's not bias. It's the positive bias you want. That's our issue. Positive bias, enabling bias, value-adding bias. That's a personal government. And you're right, Giles, it's the chair more than any other single role.
Yeah.
Can I ask a question?
Yes, please, Nadim.
My question is around, so we've gone through a period where ownership and control has moved, and we've got these corporate structures, and Nada presented, you know, we have this sort of the elite group, and we have in terms of distribution as well. In terms of the AI impact and the technology, will this shift anything in terms of how the realities that were mentioned earlier and how that will change, or do you think it will just be moving from one platform to another? What's the panel's view in terms of sort of social mobility and the impact of artificial intelligence and technology in terms of organizational forms and structures going forward for society in that way?
If I may say, I see it that's going to be a more social control. Technology is going to do more social control. And as the Giles said, show that people which are very, very off, they will be able to get better service. They will have to be opted out of that social control. And majority who won't be able to afford that will be much more subjected to social control.
Mm-hmm.
Yeah. So it is going to be technology always through the centuries, even now, it makes divide between those haves and have-nots. So that control is going to be implemented again, much more on those have-nots than on those who have. So it is a mechanism as well.
That's interesting that you just said about control, because we have another question from the audience. Saying in communism we know and we saw the power and of the information and decision making concentrated in one hand. With the automated decision now being spread all over, and how the boards will ensure the distribution of power to foster innovation at local levels?
Well, I think that's a very interesting question, and it depends on the board. If they what they call enlightened board, they'll understand that you need to distribute this decision making to organizational low downs that have interaction with the humans, and then facilitate. The whole point of being in the board to facilitate that engagement process. And of course, if the board decide that they want to have control role, then they are going to centralize that power in their hands. It is board decision how they're going to operate.
Because another thing that we're seeing in this COVID current situation is that the Gini index is increasing between those that are in control of the technology type organizations, and they tend to then be more powerful in these spheres, and then the control shifts as well. So how that plays out ahead, we'll see.
I think we already have data on this. If we take three companies, Federal Express, Anglo American and Caterpillar, for the last 10 to 15 years, they have introduced a board practice entirely based on stewardship. recently Marks and Spencer's did the same. And here, the board member has to leave the boardroom and go to the fracture points to see what actually is happening. How is strategy being deviated from its intended course because of local context? And what research has shown is there's only two fracture points. There's the fracture point between governance, the board, and the top team. So it's governance and strategy. And then there's the strategy execution fracture point between the top team and the general manager, for example, the country. What these three companies have done is they forced their board directors to go to the country and talk to the critical managers and then report that back to the board without referring to the top managers. So the reality of context is brought to board's attention so, excuse me, so that that board can deal with that. Now, Una raised a very interesting point. How can you do that when, in fact, it takes time? So one of the issues for the future may be you cannot have a board director who has more than 2 or 3 NED shifts in their portfolio, number one. Number two, are we going to select board directors who have the mental and emotional capacity to zoom in to the detail that Giles was talking about, but then to zoom out and look at the reality of the total business and how it's operating and make sense out of that? We've also seen that. And what has been the problem there? It's not been the intellectual skills, it's been the independence of the board director and their emotional resilience to maintain that independence.
Yeah, yeah.
So a lot of the issues that we are talking about now, we've experienced them, but there is one thing we've not seen with the platform organizations and with the new portfolio investment tax structures. There will be more fracture points. There could be 5 or 6 as we have multiple points in a chain where we're trying to do business. Now, how is the chairman of the board going to focus the NEDs on that board to deal with the reality of those 5 or 6 contexts? Each one could damage the business. So if you look at that, then the stewardship becomes vital, and probably the role of the chair now becomes so vital, the CEO is almost chief operating officer.
Can I pick up on that? Because I have deep experience of this, being on the board of a global law firm that had just completed 5 mergers and 3 joint ventures, trebled in size, and was in 30 different places in the world. And my role was to try and lead that post-merger integration around the culture and values, because as a business, they had already done all their pre-merger talks based on matching culture and values. And the firm had agreed a new strategy, and part of my role was to provide counsel to all 600 partners around the world. And as I did that, I would ask, and this is a great question for non-execs, what are the challenges you face? And what I began to identify was those fracture points. What were the challenges, the critical decisions they were having to make that were getting in the way of the business achieving the strategy? So, for example, one young partner said to me, you see, Una, I've been sent to Asia and I've got to win this bank as a client in Asia because they're really important in England. And finally, I've got some work, but I don't want to do it. I said, why not? And he said, well, the problem is that, you know, it's got huge environmental and social consequences, which was quite prescient of him in the early noughties. And so I don't want to do the work, even though it's on strategy. What do I do? And he said, what I've done so far is I've just quoted a price that's too high. Well, quoting a price that's too high damages the brand as well as just pulling out of the work. It began to be clear that one of the critical decisions that 600 partners would be making every day was who they took on as clients and what work they did. And how were we going to tackle that? In fact, what I did was I identified a number of other fracture points as well, that were about the way we treated our people, the way we delivered work, etc. Developed scenarios and dilemmas around those that we could then train and educate partners to recognize these points and provide them with decision-making frameworks. So with the example of what work they took on, there were 7 questions they had to ask themselves that covered, you know, is it aligned with strategy? Have we got the people to deliver it? Can we do it at a price we can make a profit from it? Have we got what would we do about the environmental and social issues? And as a result, partners were then much better equipped to make these decisions. What happened was that instead of all the difficult decisions escalating to the board, so at our level, we were forever having emergency meetings to decide whether to take on some new piece of work. The partners started feeling much more confident, and armed with the questions that they had, they started challenging each other and resolving with each other what to do and which work to do, and all the other fracture points were similarly addressed. So I think we do have some really good experience of doing this, because what you get in law firms and in accounting firms and in many other types of partnerships is there is a very strong culture of collegiality, a very shared interest in protecting the brand, because your profit depends on it, and you are the investors as well as the workers. But that's happening in some of these platform organizations. So I think we can learn from them. And as you say, I totally agree, Andrew, it gets complicated, and you have to really dig in to find where those fracture points are. But you can do that, and I think that's part of one's job as a non-exec, is to ask questions that get us to where those tough decisions are that people are making, particularly the younger people.
Okay, Una, may I add one point? It is the critical responsibility of the chair.
Yeah.
The chair, I believe, in the future not only has to make sense of strategy, they have to make sense of strategy execution.
Yeah.
And that's the point exactly that you're making. It is once the chair makes sense of that strategy execution and the fracture points, because they will increase and they become more unstable, then we can focus the NEDs.
Yeah.
The NED issue is the reporting back. And that's what you were describing. But what if we have something that's deeply embarrassing, or the chair doesn't want to hear it, or the CEO doesn't want to hear it? The NED responsibility is the independence of mind.
Absolutely.
The chair responsibility is to go and find those fracture points and get the NEDs to live that. So one thing has to change. We cannot have boardrooms that are like committee rooms.
Yeah.
You cannot sit in the boardroom. Your real work is done outside. The boardroom is where you report back.
That's interesting, Andrew. I mean, that's what I'm finding now, that, you know, when they say when you apply for a non-exec role, it says it's, you know, a day a week, you know, you have to multiply that by 5, because really all the work takes place before and after the board meeting in all those relationships. And it's one of the things I find, it's kind of, the world is moving slowly. So I find on some boards, you've got new non-execs who've been in a corporate role and are contributing very volubly in board meetings from their most recent experience. And of course, executives lap it up because they want to know, how did you deal with this situation in your last role? But actually, as a non-exec, I think one has a very different role. We have to see beyond the kind of, here, let me solve your executive problem. We have to stand back and really remain truly independent of that executive decision making. Anyway, I find all that quite a challenge, but it becomes a much more intense job than it used to be. When I was first a non-exec in the early 90s, it was an awful lot easier.
And there's one indication, if I may add, hey, I'm looking at executive roles being advertised now, non-executive roles, 40,000, 50,000, 60,000. What we're describing is 260,000.
Absolutely. Absolutely. And when I work out my rate, you know, I'm a senior advisor to boards. I do work with boards and I coach at senior levels. I get paid about 10 times as much per hour doing that. So why would you take on responsibility as a non-exec?
Agreed.
I think it can be even worse than that.
Curiosity.
In my experience, you know, and I've seen this on a number of boards actually. Generously, as Andrew describes it, independence of thought. Sometimes people don't like dissenting voices. Chairmen and chairwomen don't like a troublemaker on the board, you know, who says business model is incorrect. And a friend of mine who was chair of a board I was on a well-known financial services company, and he challenged the chair and the chief executive and said, your model's wrong, and pointed out why. And they all just tutted. And he got a phone call a week later saying, we want you off the board. He said, why? We just don't think your performance is good enough. And he actually went, unusually for him, he went public to the Financial Times and said, you know, this is ridiculous. And sure enough, an activist investor went on to the board, 6% of the company, and shook up the whole board, and off went the chairman and the chief executive. The point I'm making, though, is it's not plain sailing as a non-executive at all, not just for the challenges, but if you don't fit in, there is a groupthink power that still exists on boards, even if you want to be transparent, all the rest of it. If you don't fit in, or you're not one of us, you'd be amazed how they close ranks.
Charles, I add to that because one point you made was very interesting. It was paradox, dilemmas. One of the essential responsibilities of board members into the future will be to face more paradoxes and more dilemmas, in a sense, more misalignments. The skill will be, how do I engage across these misalignments?
Yeah.
And the intellectual and emotional skill required to do that will be more demanding than that.
Very much so. Very much so. I agree.
But I also agree with you that more and more I see on the board, they want to have shared value. You have to have the same value to be on this board. And they say, yes, diversity of thinking, but you must have the same value.
I'm slightly skeptical of that phrase, Nada, if what it means is you look and talk like me.
Well, that's the reason I said it is a paradox, because diversity of thinking brings diversity of values, right? But a lot of chairmen want people who share the same value.
And we saw that during Brexit. Sorry, for those of you who are not British, I apologise. But during Brexit, those non-execs who were pro-Brexit had quite a hard time. And they just happened to be people who had were living outside the social bubble and had better contact with what was going on, and were saying, actually, I think Brexit is going to happen. But I remember one very senior woman said, I've got to go into the city tomorrow, back to a board, and I know they won't talk to me because I said this would happen. And it's really, and that is not, you know, not because we haven't got shared values, because we just listen to other people.
So another paradox, which is for a meeting to be effective, Una, sometimes there is preparation work done by the chairman or chairwoman to make sure that if there are dissenting voices, they know about that before the board meeting. The trouble is, there's a very fine line between feedback and getting ready for the board meeting and actually choreographing it, is the word I would use. And so the board meeting goes through smoothly and there isn't much dissent or argument or anything else. And so I've been on boards where you have two levels of conversations. There's the actual formal meeting, and then what I call the chat in the corridor.
Yeah.
And much more is decided in the corridor than it actually is in the boardroom. And that's poor process, because clearly the agenda that's been put together by the board is not one that people want to talk about, because they're talking about it in the corridor, not in the boardroom. And so you often, a board meeting cannot be always what it seems. And I've done some other research where a lot of chief executives and chairmen think the non-executive directors are a waste of time because they're just nitpicking, or they're trying to look good and challenge the executive because the regulators want you to challenge the executive, or the auditors, need to be challenged. And as a number of people pointed out to me, if you challenge the executive too much, they won't give you any information. They'll clam up. And they'll hide information from you because they don't want to be picked on the stuff. And I mean, I've had non-executives say to me, how come we're spending £10 a month on potted plants in reception rather than £5? How do you explain this 100% increase in cost? No one cares about the potted plants in reception. But that's what tends to happen when people want to appear to be challenging. So the quality of non-exec value. Nada mentioned the idea of advisory groups bringing expertise into the company. I think in principle that's a very good idea. My problem with it is lack of accountability. which is how does that affect the decision making in the company if, as advisors, you have no legal responsibility as a director? And I mean, you're seeing that with politicians now, where they say, "Oh, we're just following what the scientists told us." Not good enough. You're paid as a politician to make that decision. As Winston Churchill said, experts should be on tap, not on top.
I think this issue of advisory boards is really important, Giles, because I've served on one. I got particularly interested in the governance around it. And I think there's a lot of confusion out there. You have everything from great and good advisory boards that, you know, are just there for the names, through to ones that work very hard in a very specific area, like some of the shadow boards. We're seeing employee voice boards. There has been some research around this, but I think we need a lot more about how you define the purpose, make sure that they have a voice in the boardroom, that they have the opportunity to report as well transparently. In the case of the role I play at KPMG as an independent non-exec, it's a role that is required by the regulator to represent the public interest in accounting. And within the firm's transparency report, we have our own report in which we comment on how the board is doing. And we are independent of the board. So we can't make the decisions in the boardroom. And we have to be incredibly careful not to influence those decisions, because we're powerful people. And just by saying something can influence the board more than perhaps we should. So it's quite, you know, these issues of independence are critical. And then the role of advisory boards and how you make the best use of them, I think is a really important area of work.
One of the critical questions I think this debate is leading to is why bother becoming a non-executive director, an independent director in the first place? And research shows there are 2 or 3 reasons. The first is the board is becoming very important. It is the final point where issues are going to be resolved or not, because after the board is the courts. And we would prefer not to go to court. We would prefer to have these dilemmas, concerns, and paradoxes, in Giles's words, sorted out here. Now, in that sense, this also is the ultimate point of ability and capability. So here, you have to be smart. Certainly the research has shown good board directors are both intellectually and emotionally smart. They can foresee events. They know how to put the argument together. They know how to position arguments. They know how to engage. It may take 6 months to engage on a particular point. So you're stretched, and people who want this stretch, it is a very satisfying experience. The second point is the chair, and Giles hasn't mentioned it, but he has just done some very recent research on the fulcrum of trust. The central point of trust is now the chair. And looking at the chair and what they represent and how they go about doing things, what impact they have on you, whether you can relate to the chair, is a fundamental reason. But I felt the third point was by far the most important. Why do this? Because you're going to add value.
Yeah.
And the value contribution requires considerable attention. So one perspective is, before you join a board, really scrutinize that board and the company. Don't just talk to other board members, see if you can talk to managers. Determine what your value contribution is, because one of the most uncomfortable experiences is to sit on a board, you know how able you are, and then you know you're not adding value and you don't know how to deal with it. And you slowly watch the disrespect of your colleagues increase, and you don't know how to overcome that. So is going on a board a really satisfying experience? Yes, if you want it. But please pay attention to what value you can provide. And a final word, Nada and I did a survey for British companies, FTSE 100, 200, and 300, and we asked the board members to rate their performance, which they did, including the chair. And then we asked the managers who had something to do with that board to rate the performance of the board member and the board. And do you know, there was not one company that was respected. All boards were underrated by a minimum of 40%. Now, do I know who's right? I don't. But I do know that the interface between the board and the management was fragile. And so that engagement process was fragile. So unless you live value and unless you can actually exhibit value, it's got to be seen as well as got to happen. We have a problem.
Yeah. And it's a constant question. I ask myself that all the time, Andrew, because I think your value changes as well. As you
said, value changes.
So you have to be constantly vigilant of how you're going to, you get the board papers, you're only going to be able to contribute 2 or 3 times, determining where you can add the most value. Who else on the board will actually be able to contribute those points that you don't need to contribute? So you have to add the extra value rather than leaping in early with the easy bits.
And Una, can I, from a personal experience, indicate I sat on the board, I felt my value was diminishing. It wasn't anything to do with me, nor the board. It was just diminishing.
Yeah.
You know how difficult it was to leave?
Yeah.
And to prepare the chairman and the others, I am not insulting you, I am not criticizing you. It's just my value is diminishing. I don't have much more value to give.
Yeah.
I found myself to be in a minority position because I thought some of my colleagues also should have been asking that question and raising that question, but they don't. So the value contribution and how you then reposition value as a board director is a sensitive concern, and it should be one of the concerns of the chair.
Yeah.
Dear,
Can I ask a side question?
Nadim, I'm afraid I have to really hurry you, so please put it quickly. We have
My
2 minutes.
my question is very simple. Una and Giles, you mentioned in terms of flatter organizations in the service sector side. So I can see that happening. In terms of then, if you look at the manufacturing side or production side, then technology tends to impact in terms of HR going forward and manual jobs and those sort of implications. So what sort of board responsibility is there in terms of then, if you talk about organizational structures and that shift taking place? Do you see the director responsibility in it sort of with the engagement with technology there?
My answer to that, Nadine, would be that I did interview a chairman who's chairman of a very engineering business, and he had a financial background. But his view was that he assembled a board of talented people who knew the business well. But his view was that they did a lot of plant visits, individually and as a group, all over the world. So he spent a lot of time when he could in an aeroplane. And I think it was that walking the plant point, where possible, gave more confidence to the people when decisions are being taken that the board actually knew what they were doing. Reverting to Andrew's point, when the senior management asked what they think of the board, the answer was not very much, or not as much as you'd think. And that's often to do with things like visibility. I chair a company currently where we've won some contracts recently, and I've spoken individually to each of the managers who won those contracts. And I'm not boasting. I loved that because it meant I was taking an interest in what they're doing commercially, rather than in the past there'd be a vote of thanks at the board, but no one sent the minutes to the managers who actually got the deals. So I think visibility is the key there. And with the technical changes, is explaining why the company wants to bring more technology in to the employees. And if it means some of them sadly lose their jobs or get retrained, that's unfortunate, but nevertheless it has to be done. So by communicating, and I think the crisis we're in now currently has been a real test of corporate communication rather than anything else. And if that's done well, you've built greater employee loyalty. Actually, we are encountering also people who've decided they don't want to do their jobs anymore because they've been locked down for 3 months and rather like being locked down. That's fine too. But the key is making sure visibility and credibility of your decisions, I think, to make those changes.
Giles, you're so right. Visibility is engagement. Decisions are not.
Yes, I mean, the only thing I could add to that would be being very aware of 2 things in addition to what he said. The social inequalities that you might be exacerbating in the community as you bring in the automation, and what you can do to retrain and reskill people rather than them having to lose their jobs. And also the extent to which the automation requires a different kind of human interface, and what that is, and how you maybe have, there's always a tendency to bring in new people rather than thinking about how could we take the people we've got and retrain them. So it's really actually the same point as how to do that. And then if the board directors have that visibility and credibility, then they're going to be helped to be part of that transition to using the automation positively and responsibly.
Thank you, Ona. I'm so sorry that we have to wrap it up here and to close our call. We have received still questions, especially from the cohort, from the postgraduate qualification program, but also from the audience as well. I will send an email with them. Could you please, as usually, fill it in as you feel right for you. And I have to say again, thank you very much for the wealth of the insights that you shared with us. And thank you for your time. I know you are very busy people. You have a lot of other activities that you pursue every day. And we can see from everything that we have spoken today that there are still a lot of other open topics. We have noted them down, and for the next series that of the future of governance that we intend to build up, we are going to use them. Thank you for being available, and we trust that you would also feel good about our event and come back to us again when we are going to pursue the topics that we have spoken about today and that you are interested in as well. So thank you very much. Thank you, Nada, for your presentation. Thank you, Andrew, for introducing Nada to us already 3 years ago. So thank you again. Thank you, Ona, for your time, and Giles for your time, and look forward to seeing you again on our next roundtable. Thank you.
Bye. 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 Bye.
Bye all.
Thank you.
Bye. Bye.
Thank you.
All the best. Thank you. Bye.
Bye.
Thank you. Bye.
Thank you. Bye-bye.
You too.